All right, let's look at the data. In early 2021, the market witnessed an anomaly that basically broke every traditional model out there. It was a battle between institutional short sellers and a decentralized army of retail traders, all focused on GameStop. Now, this wasn't just a stock story. It was a fundamental stress test on the entire market structure. So today, we're doing a data-driven deconstruction of the mechanics, the catalysts, and the critical lessons for every trader.
At the heart of this whole thing was a huge divergence in how people were reading the data. And this quote from retail analyst Keith Gill, you probably know him as Roaring Kitty, it just captures it perfectly. He saw a deep value looking at the fundamentals, while the big institutional money, backed by massive short positions, was just overwhelmingly bearish. See, this is where market anomalies start, right here, when one data-backed thesis goes completely against the institutional consensus.
And that divergence? Well, it led to this. A price dislocation of truly historic proportions. Just look at the scale of this move. In a matter of weeks, GameStop went from being this forgotten value stock to one of the most traded equities on the entire planet. Now, this wasn't normal price action. This was a structural break. An event this extreme is never random. It's a result of specific market mechanics being pushed to their absolute breaking point. So, let's dissect the engine behind the mania. To really understand what happened, we need to look at the market's plumbing. The conditions for the GameStop event, they were building for months, hidden in plain sight right there in the data on institutional positioning. And it all starts with a very common but incredibly high-risk financial practice.
Okay, first, let's break down short selling. Simply put, it's a bet on a price decline. An investor borrows shares, sells them at whatever the current market price is, and their whole goal is to buy them back later at a lower price. They return the borrowed shares and pocket the difference. But, and this is critical, the vulnerability here is the risk. Your potential profit is capped at 100%, right? The stock can only go to zero. But your potential loss is theoretically infinite. If the price goes up, you still have to buy back those shares to close your position, no matter how high they fly.
And that unlimited risk, that's exactly what creates the potential for a short squeeze. When a heavily shorted stock starts to rise unexpectedly, those short sellers start losing money, fast. To stop the bleeding, they're forced to buy back shares to close their positions. But what do you think happens when thousands of short sellers are all forced to buy the same stock at the same time? Well, their buying just adds fuel to the fire, pushing the price up even more, which forces more short sellers to buy, and you get this powerful, explosive feedback loop.
This is the critical data point that made GameStop a powder keg. In mid-January 2021, the reported short interest hit 114% of the publicly available shares, the float. Yeah, just let that sink in.
The visual of a coiled spring is really the perfect way to think about it. The institutional players had created this impossible scenario. More shares had been legally borrowed and sold short than actually existed for trading on the open market. This wasn't just a bearish bet anymore. It was an extreme, structural imbalance. All it needed was a catalyst to violently release all that stored-up energy. And that catalyst? It came from retail, a decentralized collective of investors, communicating on platforms like Reddit, looked at the exact same institutional positioning data, but their interpretation was completely, radically different. They didn't see a failing company. They saw a massive opportunity created by institutional overleverage. And the escalation, as you can see from this timeline, was just breathtakingly fast. What started as some deep value analysis in mid-2020 just ignited in January 2021. That price spike on January 13th, that probably triggered the first wave of forced short covering. By the 26th, you had major funds deleveraging at massive losses. And just 2 days after that, the stock peaked right as the market's own infrastructure stepped in. The damage to the short sellers was immense. We're not talking about small paper losses here. Melvin Capital, a multi-billion-dollar hedge fund, was forced to take a bailout and eventually had to shut down entirely. Citron Research, a really prominent short seller, announced they wouldn't even publish short reports anymore. The total losses ran into the billions in just a matter of days. This was one of the largest transfers of wealth from institutional funds to retail investors in modern history. Right at the peak of the frenzy, the volume and the volatility got so extreme that the market's internal plumbing, the systems of clearing and settlement that operate behind the scenes, they just started to buckle. And this led to the most controversial moment of the entire saga.
So on the morning of January 28th, right when the upward momentum was at its absolute fiercest, retail traders woke up and found they couldn't buy shares of GameStop on a lot of the popular brokerage apps anymore. They could sell, sure, but they couldn't buy. The buy button was effectively turned off for retail, while the institutional players, they could still trade.
And this created two completely different narratives. On one side, you had the brokerages like Robinhood saying their hands were forced. They said the clearinghouses that settle all the trades, the market's core plumbing, demanded billions in new collateral literally overnight to cover the extreme risk, and they just didn't have the liquidity. But from the retail perspective, the timing was just way too convenient. They saw it as the system changing the rules mid-game to protect the institutional funds that were on the ropes.
The fallout was, you guessed it, immediate and intense. Dozens of lawsuits were filed. Congress held hearings grilling the CEOs of Robinhood, Citadel, and Melvin Capital, and it put a huge spotlight on the complex and, let's be honest, often opaque relationships between retail brokers and giant market makers, specifically the whole practice of payment for order flow.
So what's the takeaway from all this? The GameStop saga was a fascinating case study in market dynamics, crowd psychology, and systemic risk. But as a strategy, it really raises some important questions about how retail investors should think about creating wealth.
Look, it's absolutely critical to recognize this for what it was, a black swan event. The combination of factors, over 100% short interest, a unified social media catalyst, a specific market structure vulnerability, it's incredibly rare. Trying to replicate this is not a strategy. It's like trying to catch lightning in a bottle. This was an anomaly we need to analyze, not a new playbook to go out and follow.
This whole event really highlights a fundamental choice in how you build wealth. On one hand, you've got the GME model. It's highly speculative, focused on identifying these rare market dislocations for potentially explosive, but very uncertain gains. On the other hand, you have a philosophy like FIRE, financial independence, retire early, which is built on the complete opposite principles: discipline, a high savings rate, and a long-term focus on steady compounding in diversified index funds.
And this quote from a user on the Financial Independence subreddit really sums up that alternative path perfectly. It's not about finding that one lottery ticket stock. It's about a disciplined process, earning more, saving aggressively, and just letting broad market index funds do the heavy lifting for you over decades. Sure, it's less exciting, but it is a statistically proven path to wealth. The GameStop event was a serious wake-up call. It proved that extreme institutional positioning creates vulnerabilities, and with those, massive opportunities. So it leaves us with a critical question for today. What hidden imbalances, what pockets of extreme sentiment are building up in the market right now? Because the data is out there.
And just a quick reminder for everyone, this analysis is for educational purposes only, and it's based on historical data. Markets change incredibly fast. This is not financial advice. Please always do your own due diligence.
We are tracking these flows in real time. While you analyze the next move, check out the tools in the description. Sign up for Public to get $20 in free assets, check Webull for that BTC promo, or look into NVDA on Moomoo. Links are down below. Like and subscribe for more deep dive analysis. Stay disciplined, stay liquid.